So today's Cardinal lesson, we're talking about a guaranteed income for life. Sort of like your Social Security check. That's a guaranteed income for life. And after the colon, a license to spend. And so we got a hold of a research paper, and we don't typically do shows on other people's research. I mean, most of the research that's done for these shows comes right out of our practice. And we're day to day, month to month, talking to hundreds of people and I guess into the thousands. And we're doing financial planning and we get so many situations and the solutions. So the topics for the show really comes out of our practice. In this research paper from David Blanchett and Michael Finca, I think I got that right. Um, this really hit home with us is that as Tom and I are reading this research paper, we just found things that we have found to be true in our day-to-day practice. So I want to bring Tom on, and I want Tom to talk about why we're doing this video today.
Yeah, I mean, we're doing this video because we have a lot of clients that walk through our doors that we're doing financial plans for that have been great savers. They've done a really good job of putting money away, setting it aside for retirement, being very disciplined, and now they're meeting us sort of right at retirement, and they have a really hard time spending it. It's sort of ingrained in them that they've been these savers and they don't know how to spend the money. And so this isn't everybody, but this show is really for that subset of clients that really it sort of makes them feel really nervous to spend some money. And so we just want to show you a way to set it up to give yourself permission to spend it. I mean, and a lot of that is around the behavioral aspect of it, right? Is if you're saving it and that's been ingrained in you, it is really hard to switch that, make sort of that transition, go into the sort of distribution phase of your life and start pulling it out and living off of it. So I'll turn it back to Hans. Well, actually, before I do that, let me bring up the show notes. These show notes are at the link below our video. They're also on our website. We have the board as always, and then we have the research paper with some of the key points highlighted throughout it. So if you were interested in reading this for yourself, if this really feels like it hits true to you, go through and read it. I mean, again, you're not alone. There are a lot of people that are in that boat that are just have been good savers. It's hard to spend. So let me turn it back to Hans on the board and we'll get going here.
Yeah, and the theme of the research paper is that shifting some of your assets to income annuities, they studied a whole bunch of retirees and they learned a lot about these underspenders or people that spend less than they otherwise could in retirement, which isn't necessarily a bad thing. But what they found in their research is that these people really have an underlying desire to spend more money on themselves to enjoy their retirement, but they're afraid of something or they're afraid of running out of money. They're afraid of living too long. There's a lot of deep seated fears because they just have this glob of money that they're saving. They've been successful in saving it. And they're saying that if they shift some, an emphasis some of their assets into income annuities, it gives them a psychological license to spend. So I'm showing you an example up here. This is not a financial plan. This is not a complete financial plan. This is just showing you what you could do for two people 65, a couple, or one person 65, what you could do with a $500,000 principal in terms of creating an income for life or the life of two people. And by the way, these numbers, if you're older than 65, and maybe you started your retirement and a few years have passed and now you're approaching minimum distributions and you kind of have a hunk of money out there and you haven't been spending, and so you want to get where you're sent a check every month for the rest of your life. The numbers on people in their 70s, this is one of the few products that actually gets better the older you are when you start it because you have less life expectancy left. But let's look at the example. In this couple, we put $500,000, which presumably is some of their assets, into this is really two annuities, and it's going to generate a $3,090 a month check that is guaranteed by the insurance companies to last as long as either one of you is alive. Okay, so if one of you dies at 77 and the other one lives to 95, this will have been a great decision. And the check doesn't stop until the second one is deceased. And this $3,090 a month, $37,000 a year is 7.42% of a withdrawal rate. That's not an interest rate because you're spending down your principal. It's guaranteed for the life of both. And if you both met an early demise or an earlier than spending down the money through annuity checks, the unused balance is going to go to your beneficiaries. So this is just an example of this couple that has a glob of money that's living off their social security checks and maybe a little pension or something, and they're just, they're getting by on two social security checks, and they've got this big glob of money. They need somewhat of a license to spend some of it, and that license is created by a check coming in every month. I mean, the money just gets pushed to them into their checking account, and maybe it's larger than this, maybe it's smaller than this, and it's in addition to their other checks, and they can freely spend it knowing that there's going to be another check coming in next month. Now, if the second one died at 85, that 500,000 will have paid out 741,000 to them. And then if the second one lived to 95, it's over $1 million of payments. But that's not the point of a large sum of money. The point is the check coming in every month, and you can freely spend this month's check because next month there's going to be another check for the same amount. Now, for a single, the numbers get a little bit better. So it's a withdrawal rate of 7.92% because we're only guaranteeing this on one life. And if a person did pass away, or the second one here and the single did, there's going to be some unused cash balance that's going to go to the beneficiary. So this money is not gone when you sign up to this thing. So the whole point being is we want to push a check out. You're pushing a check out to yourself through the purchase of an annuity, or the insurance company's sending you a check every month that you have a license to spend that. And I want to push it back to Tom. I want Tom to talk a little bit about really some observations that we've made, and they end up becoming recommendations for specific people.
Yeah, I mean, so we have these points down below the board that gives us a little more context of sort of what's going on here. The first one is really around Social Security. And so when you look at Social Security, that is essentially an annuity. Now, it's backed by the federal government as opposed to a insurance company. But what they're doing is they're sending you a check for the rest of your life, and it has a cost of living adjustment. So it has some inflation benefits there too. So it's really the best annuity that exists is Social Security. When you look at starting it at your full retirement age, or you're considering delaying it till 70, if you've watched our channel, you know a lot of times we recommend delaying it till 70. Part of the reason behind that is that check grows by 8% a year by delaying it. And so another way to look at that is getting 8% return on your money guaranteed. And so what's really nice about people who are in this scenario, a lot of times they have a desire to get that higher check. They want to wait till 70. That gives them some more income coming in because they know that's sort of what they're lacking now. And so they're doing that. So in that sense, they have that they understand that sort of philosophy, but then it comes down to their money and they don't want to spend any of it, right? So again, it's sort of a balancing act. And we certainly aren't recommending going out and not being mindful of what you're spending money on, right? It needs to have some control around that. But we're really talking to the people who spend almost none of it or very little of it when they could spend a lot more. And the other thing I just want to bring up is a lot of times these are the same clients that are telling us that leaving a legacy is not their main priority, right? It's like, yes, I want to leave some to my kids, or maybe I don't want to leave any to my kids, or whatever that is, or you don't know who that beneficiary is if you don't have any kids. So that's not a priority. But then you look at their behavior and they're not spending any of it and said, well, wait a minute. If that's not your main goal and you're not spending it, that kind of is what your goal is going to be, because that's what's going to happen. If you don't spend it, someone else is going to get it. And so that's sort of it takes some thinking there. One of the other points we have on there is, again, this is sort of the point of the whole show, is we're talking about annuitizing some of your savings. So not all of it, not taking your whole pot of money, putting it in annuity, but taking some of it, setting it aside. It gives you sort of the freedom to spend that money because you know the next month comes in, you got another check coming to replace that one, and that's going to last for the rest of your life. Um, One of the next point is significant savings. This really has to do with the fact that the people who have the hardest time with this spending often are the ones who have the most savings. They've done the best job saving this money, and now they're the hardest ones to convince to spend it. What you would see would be backwards. Like you would seem like, hey, if you have that much, you'd have no problem spending it. But in reality, that's not what we see. We see the people who have the most have the hardest time spending it, and the research really shows that backs that up. And so, Hans, why don't you sort of take over sort of the next points here?
Okay, so the underspending reasons, I mean, we just talk about, so in the study, they identified, so what are the reasons people don't spend this money on themselves? Is they want to leave an inheritance. Second thing is uncertain medical expenses, and that's a real thing to be scared about. And unknown life expectancy is they don't know how long they're going to live, so they think that they just need to keep this money stacked up there in case one of these two things happens to them, or they're going to just pass it all along to their kids. So generally, people that are savers and that have wealth and have accumulated savings, they have a general dislike of seeing their balance go down. I mean, it's just their whole life they've increased it, and it's like they're doing something bad if they spend their own money. Um, Underspending increases with age, and so we're not against underspending here. So we're financial planners. If you want to help us so that plan so that you can pass away with the most money, we're the people to talk to. I mean, we can do tax planning. We can even plan for savings in retirement. So we're not against, saving money. We're just sitting here talking to some conflicted people when they've saved all this money and they said all along this was for retirement, and now they are retired or they're just fixing to retire, and we want to know what's the pot of money, what in the end, what's this all for? And that's a question I ask a lot of people. You can ask yourself, what's this money for? It's either to leave behind for my spouse in case I go first, and then I got to ask the spouse, what's it going to be for then when you've got this for one person, and then, or is it to leave to the kids, or is it, what's it for? And it's just our feeling that when we really dig out of people, they want to go do some things. They want to take the whole family on a vacation with some of that money. They'd like to give some of that money to their grandchildren's college education, or they'd like to go spend it on themselves, do a bunch of traveling, um, get a second home. I mean, there's all kinds of things that people come up with, and we pull out of them. What we're talking about here is the dissonance where people are, they're saying one thing but they're acting in a different way, and they're doing it in front of us because we got all their money laid out, and we're going to make some recommendations, tax recommendations, cash flow recommendations, estate planning recommendations, long-term care recommendations. So they're having the discussion with us, and we're just trying to help them achieve their goals. And typically we just have a lot of people just living off their social security. I mean, that's just, yeah, I, I have a lot in common with that. I mean, at home myself is, you know, my wife gets some enjoyment out of shopping on sales and getting by with less. And that's all of a virtue. But in the end, when we're retired and we've got plenty of time on our hands, I intend to spend some of our money. I mean, that's just what I'm going to intend and lead the family to do. Underspending increases with age. We see this a lot, is that people in their 70s and 80s that have a lot of money, their spending is even going to cut back because they're worried about a stock market decline. They're worried about a healthcare event, even though they have long-term care insurance and good Medicare supplements and Medicare. They're still generally, this increases with age. Annuitization, which annuitization is just paying you a check every month that's guaranteed not to stop until you're deceased. It deals with longevity risk, and it also deals with market downturns. So if some of your money is over here and they're pushing out a check to you every month, you can have a license to spend it. And then the balance of your money, you can worry about that on the balance of your money, but that's not really going to be tied to your spending. So the retiree spending does not track to full inflation. And they typically find that as people age and inflation happens, they're not going to increase their spending by the amount of inflation. If anything, they're going to tend to cut back with age. And then what we talked about, and we've done this in other videos where we talk about the go-go years, which is the 65 to 75, where you're going all the time. And then, somewhere around the mid to early to late 70s, you move into the slow go years where you're just not moving as fast. You're not as interested in vacations. And so you're actually going to spend less money because you're not out spending it on things. And then the no go years, that's even less spending, but the spending, if it's there, it's going to be long-term care, which we're going to recommend insurance for that. And so I wanted to go over, I think we've beat this point to death where we're just going to set up possibly for people that, really want a license to spend and they want to go out and enjoy some of their money. We're going to take some of it, put it into an annuity, guarantee it as long as they're living, they're getting this check every month. That's a good thing. And once people understand this, they're going to sign up for some level of it. So what is the downside, or what are the fly in the ointment to everything I'm talking about? One is inflation. And the way we deal with that is we're just putting some of their money, we're going to help them invest the rest, or possibly ladder these type of annuities where some of them start later. Long-term care, and long-term care just throws a hole that people say, that's what I'm saving for. That can be mitigated with long-term care insurance. Low returns. When you buy annuities, you're just not going to get big high flying. This number right here, these two numbers, they are not returns. That's a withdrawal rate. So you're going to be dealing with low returns because you're also parting with the risk. You're going to have zero risk of losing money or getting zero for a year. And then, this is a lifetime commitment. When you sign up for one of these things and you're getting a guaranteed check for life, you're sort of in that for life. So just wanted to go over a few downsides as we close. This psychological license to spend more. That's what the thesis was of the research paper. That's why we put it in there. We wanted to show you an example of what a lifetime check is going to look like. I want to go over the points within comprehensive planning, and we've checked. We talked about Social Security. We talked about Medicare and healthcare costs. We talked about a long-term care event. We talked about a 401k and an IRA, which is where a lot of this money is sitting right now for a lot of retirees. This whole video has been about income. People are going to be more inclined to spend income than they are spend out of a large balance. So it's about creating an income that gets pushed at you every month, and you're going to feel a little safer to spend that on a monthly basis. Estate planning, we've touched on that today, and we're not ignoring the estate. And taxes, the box is not checked because not because we're not concerned about it. When we do comprehensive financial planning, we're going to figure out a way to get this annuity check coming to you in the most tax efficient way. But it wasn't talked about in this video, so we didn't check the box. I want to bring Tom back on. I'm Hans Scheil.
And I'm Tom Griffith.
And we thank you very much for listening.
Thank you.